Hi guys, this is Zeno Lars from Tonningen, and today I'm going to talk about market volatility. We've all seen the markets nowadays go up by 10% and going down by 12% the next day. Seeing how crazy this can be. Not only is this not good for your blood pressure when you're investing, it also raises the question, why do markets go up and down like that? This is exactly what I'm going to explain in this video. So first of all, markets go up and down after an event has happened. For example, the market slowed down, or in today's case, coronavirus is spreading worldwide. Now this causes the market to sell off due to the fear of losing value. And this is usually started by institutional investors. Now, institutional investing companies are investors that invest for other people using their money. And when the word is out that one institutional investor is selling their stocks because of fear of something happening, usually this is a ripple effect and all the other institutional investors start selling off as well. This causes the market to jump down considerably, but it's not the only factor that is causing it to go down. As now we get into the territory of what's called margin trading. Margin trading is basically buying stocks with money that you've lent. But they can't just lend this money. They have to have collateral against it. Usually this is the same value of the money they've put in and invested into the stock market, which they can lend against. So for example, if I buy one stock from Amazon for $2,000, that would mean I would be able to lend additional $2,000 to buy additional stocks with. These institutional investors are doing this so that they can double the gain that they get when the market goes up. Now let's take that example of Amazon again, and let's say the market drops with 20%. Now the overall value of the stocks that you bought for your stock and your margin stock is $3,200, so you dropped $800. This means you're now borrowing more than 50% of the value of the stock, which means you're over leveraged. And when you're over leveraged, this would trigger what's called a margin call. That would basically mean you have to get back to that 50% of the value of the stocks, meaning you have to sell stocks to get back to that 50% or put extra money in. And if they don't match that 50% within 24 hours, the stocks are automatically sold for them. Later video, I'll explain exactly how margin trading works, as this is a video all by itself. And because the investor is selling more of their stocks, this is also causing the market to go down more. Coming to the last part of why markets drop so much, and that is the main factor, fear. As when individual investors like private investors see the markets drop that much, fear comes into play and they start selling off because they do not know what's going on. And because these private investors are selling more of their stocks, that also means that more of these stocks of the institutional investors need to be sold off because they're not reaching the 50% margin requirement. And this spirals out of control, making it drop 10, 12, 14% on a single day. Now, these are the main factors of why the stock market drops so much in a single day. Fortunately, after days that the stock market crashes like this, the very next day, the market actually increases by a bunch. And the reason why this market actually increases the very next day is because of value investors. These are investors that are investing into stocks for the long term. And a good example of a value investor is Warren Buffett. When these investors buy stocks, they just think about the long term. So they don't care about the short-term volatility that comes into play when the market crashes. And when these stocks drop so much, they consider them bargain buys because of the value that this stock actually has. This causes the market to go up again, which causes the institutional investors to increase their overall value of the stocks that they have, which means they can lend more on margin. And as these institutional investors start buying more stocks, this causes the market to go up even more rapidly. As the private investor sees the increases happening, they want to tag along, so they start buying in as well, causing the market to go even higher. Now guys, hopefully you understand now why the markets drop so suddenly and they increase so suddenly on specific days when markets crash. And of course, if you like this content, please smash that like button, subscribe to this channel, and show us some love so that we can create some more content for you guys. So if you guys have any ideas or any comments about the video, please leave those in the comment section below and I'll get back to you as soon as possible. Thank you for watching. Until next time.